Hey, what's going on, cash flow hackers? It's Chris with Life 180, and I'm nervous and excited all at the same time about this video. I do obviously a lot of videos talking about Index Universal Life and the downsides of Index Universal Life, and obviously if you follow this channel, it's no surprise how I feel about that. We're going to get into that a little bit, but really the focus of this video is talking about infinite banking and the misrepresentations of infinite banking. Here's the deal. Let me before I get into anything else, let me kind of tell you what's inspiring this. And I got to be real with you. I'm a little bit nervous right now because, you know, I don't want the whole world to hate me. Quite frankly, I always tell people I don't really worry about what people think or say about me, and you know that's why I'm doing this video, because I want to stay true to that, and I'm gonna stand on my truth, what that is, no matter what. And here's the deal. I love infinite banking. So before I get into this, I want to say, from a foundational view, infinite banking to me is still an amazing strategy when you look at it foundationally and when you look at it what it is. And I'm going to explain what all that means as I get into this. But here's what I'm seeing is for my integrity, I feel like I do a lot to call out the IUL people, right? And the universal life world. And I've been seeing a lot of things in the whole life space, in the infinite banking space, where, you know, certain components of everything have been a bit misrepresented, right? And so what I wanted to do in this video is take an opportunity and kind of share where I think that misrepresentation is taking place, how it really works, and ultimately, get into all the nuances of infinite banking, where the challenges are, where it really works, where it can kind of be risky, where some of this stuff that's being focused on to sell more infinite banking policies really doesn't make that much of a difference, right? Yet it's being glorified and made sexy, and it's like really good clickbait, and it's all these things. And at the end of the day, like the foundational component of what this is, and like what Nelson Nash did when he created infinite banking, it doesn't need all these things that I'm going to get into. And so behind me here, I have a list. I've kind of been just on my board here for the past literally like couple hours as I've been like sitting down and like really contemplating this, because I don't know if you know this or not, but I'm literally like rewriting my cash flow hacking book. And I don't know if you've ever wrote a book, but there's so much introspection that goes into writing a book. It is one of the most like rewarding things and one of the most challenging things that you do all at the same time. And so in my process of writing that book, and I think about like, what am I trying to do? What am I trying to convey? And being able to kind of step forward in full integrity and really serve people and give people the information that they need to gain control of their life financially. You know, it's a big undertaking. And that undertaking has gotten me to think about infinite banking in these terms, because I'm not gonna lie, I've fallen prey to a little of this myself, you know, and I always try in the videos to be very clear about where the lines are and how it really works, and you know, get to the truth. But at the same time, I can't lie. I mean, I've utilized certain terms and strategy, or like clickbait kind of stuff, if you will, to get clicks. But then, you know, I always get into the truth in the video, but I should also be aware that not everybody watches the entire video. So I look at that as a level of responsibility as well. So I'm going to try to be better at that. But here's the deal. I'm going to go through this now, and my goal, and I don't know how long this is going to be. This could be a really long video, or I might get through it really quickly. The one thing is, I can tell you this is not scripted out. I've got a couple bullet points back there that I just want to like focus on and have a conversation about. And ultimately we'll get through this. And as I do, like, I'm happy to engage with any comments. Anybody has any questions, you can always email me, Chris@Life180. If you're just here for the first time and you're seeing this and you're not sure what I'm talking about, or maybe you're an infinite banking person or an IUL person, you're looking at this, I would encourage you to subscribe, hit the bell. That way you're notified, because I'm sure I'm going to have a lot more videos to follow up on this. And that'll be what it'll be. But all right, so let me do this. I'm not even going to go to the board, but I'm gonna just circle these as I kind of talk about them. So Libertarian philosophy. So the core components of infinite banking are really centered around a libertarian philosophy. Now, if you don't know what a libertarian philosophy is, it really is focused around Austrian economics. And so if you know anything about Austrian economics, and versus Keynesian economics, which is what we live in, where we have the fractional reserve banking system and the elastic currency and all this stuff. Austrian economics would be more focused on like having a gold standard and having a fixed money supply and not being able to just print money on demand. And there's more to it than that. You can look into it, but Austrian economics is typically tied to a libertarian philosophy. Libertarian philosophy believes in small government, believes in individual rights, and when it comes to banking, the whole idea of Nelson Nash when he created the infinite banking concept was you want to control your life, right? You want to control the banking function in your life, and I'm not going to get into all the details of that right now. I may end up diving into that later in the video, but for the sake of this, it's important to understand that libertarianism at its core and Austrian economics at its core, those two things are fundamental to the philosophy of infinite banking. Now, that's not a bad thing, right? That's not a bad thing at all. What I think can be bad about that is that there's a certain segment of the population, I myself am one of them, that have this leaning and affinity and attraction, kind of like a moth to a flame, of freedom, right? And so when we look around the world and we look at what's happening, we want to have massive self-accountability and we want to control the results in our life. And so with that, infinite banking is a great concept. And once again, I will hold true that I believe that to be true. That is why I love this. That's why I preach what I do. That's why I do what I do. The problem that I'm realizing, that I'm starting to like have a sense of unease with, that I see going on in the world, is that there's so much clickbait going on. There's so much talk about elements of infinite banking that are really not at the core of infinite banking. And those challenges allow the concept to be bastardized. And those concepts allow people to be misled, misunderstand, and I'm gonna get into that as we go here. But for the foundation, I wanted to just talk about the fact that it is more of a libertarian mindset. And the term infinite banking is just a marketing term. So it's a trademarked marketing term, but really infinite banking on its own is just that. There's a lot of people that have taken the concept and called it cash flow banking, bank on yourself. There's all sorts of different other marketing terms around the concept, but at its core, it really is just an overfunded whole life insurance policy. And infinite banking comes in when you kind of tie together the libertarianism, the Austrian economics, and how you actually utilize the policy, okay? So that's important to understand. So I myself have been guilty of taking advantage of the search and the marketing of infinite banking. And the challenge for me with that is that, I'm not a pure infinite banker. I don't believe in all tenets of infinite banking. Now, do I believe in 98% of them? Absolutely I do, and that's why I do it. So here's the deal. I've been talking about this a little bit. The fundamentals of infinite banking are pure. So here's the thing I want to explain. When you look at the fundamentals of infinite banking, it's simply saying, okay, I'm gonna overfund a policy. I'm going to have liquidity of that policy instead of having my money in a bank. Whenever I want to go make major capital purchases, I want to borrow against it to leverage for investing purposes, whatever. The foundational function of infinite banking and a properly designed whole life insurance policy is you're borrowing against it. And when you do that, what happens is that then becomes that loan. You're never borrowing out of your cash, right? So, and I'll do this real quick. I'll hop over here real quick and I'll do this. So what happens is and this is why it's pure. So if you have your policy and you have your cash or you have your let's just go your premium, and let's just call it 10K, right? And then you have your cash value, your net cash value, we'll just call it. Let's just call that 7,500 just for the sake of it. And then you have your death benefit. Okay, and the death benefit, let's just call it 200,000. Okay, so what will happen, and if you do it the right way, it's probably 200, but then by the time you have the 7,500, maybe you got 208,000 of death benefit. So it'll be what it'll be. Now, what happens here, if you want to borrow against this, maybe that's year 1, and then by the time you hit year 5, you've put 50,000 in. You know, you probably have about 50,000 at that point in time. It's probably close to break even. It might be like 48,000 actually. And then the death benefit will have grown to probably 250,000, something of that nature. If you're using the right blend of paid up additions, it's roughly ballpark about what it's going to be. Okay, so when we look at this, what's happening here is if we borrow, let's say we want to borrow to buy a piece of equipment for our company. What's going to happen is we borrow 40,000. Okay. So we don't borrow 40,000 from the policy, we borrow it against the policy. So we leverage this 48,000 that I should probably draw more cleanly so it's not scribble, right? We use this 48,000 as leverage. So we're going to borrow against it. The life insurance company says, okay, we're going to give you a $40,000 loan, but we're going to charge you whatever interest rate for it. And so let's just call it 5% for the sake of argument, right? So now what's happened is you get this loan. Now this whole $48,000 is growing uninterrupted, right? So you didn't interrupt compounding interest, but we're going to talk about this a little bit more later. I just want you to understand how this works. So, but here's the deal. Your, what we call collateral capacity goes down by the 40. So the 48 minus 40, now you have collateral capacity of 8,000. You cannot borrow any more than your collateral capacity, right? So as you start to pay the insurance company back this $40,000 loan with the interest, anything above the interest expense on this loan, you will recapitalize this money over here, and this $8,000 can go up based on how you pay off this loan, right? So that's really important to understand. So if you get that, then you understand that the fundamentals are pure, because here's the deal. This 5%, think about it right now. Over the past 10 years, if interest rates were, 3% or 2% for bond rates, right? They had policy loans that they were lending out, and that's 5%. That 5% is an asset on the books of the life insurance company, because they're taking this 5% loan, this $40,000, they know they're going to get there. And what it does, because remember, every time the life insurance company has death benefit, that is an obligation for the company. It has to meet that obligation. So they have a $250,000 obligation that they have to back up with a certain amount of liquidity, and they typically use bonds to meet the liquidity, right? That's what they do. And so what happens here, when you take a loan, even though the bonds are only paying 3%, so right now they're relying on old bonds from years ago, okay? I mean, talking back in the 80s, they bought bonds in the 90s. Now we're not, like go back 30 years, 1992. They've got bonds that are still maturing from 30 years ago because the bond market was higher back then. And so it is propping up the market right now. But here's the deal. 5% loan rates right now, that's a 5% asset. Not only that, but they guarantee that with the death benefit. So the net death benefit here, after all said and done, it drops to 210, so their liability is lower. So this 5% asset on the books is actually a very good thing. So what happens is the life insurance companies are totally good with managing that kind of risk. And this is one of the reasons that they love to give high liquidity. That's one of the reasons they love to give policy loans, and that people have guaranteed access to these policy loans. And listen, fundamentally speaking, it works. It works on the balance sheets of life insurance companies, and it works for the policyholder. And so I'm going to get into kind of a little bit more on how that works, but I really wanted you to understand that as far as policy loans go, this is, from an infinite banking perspective, this is how the life insurance companies make it work. And you need to understand that, okay? So this gets me into the next point of infinite banking is not about positive arbitrage, okay? All right, now this is gonna be where I get a little, maybe bring in some haters. I don't want to bring in haters. So here's the deal. As much as a lot of people love to talk about it, and I myself have been guilty of this myself, talking about the benefits of positive arbitrage, I don't want to sit here and tell you that positive arbitrage cannot happen inside of an infinite banking policy, because it can happen. And even though you can do that, what I think it's important to understand is there's a lot of people that are really focusing so much on that kind of clickbaity element of the positive arbitrage. And the danger in lies of the positive arbitrage is to once again not say that it's not possible, because it is possible. And I think this concept in whole life developed because we've been living in an environment that is provided the ability for positive arbitrage to exist. But and once again, I'm not trying to talk negatively about it, but I think if you are an agent, you need to understand how this works. And I think if you're a person who is looking to buy a policy for your life, you need to understand how the moving parts work. Now, what I'm going to do here is I'm going to show you how if you started a banking policy today, you're probably not going to have positive arbitrage in that policy for the life of the policy. You're just not going to. And I'm also going to show you after why that doesn't matter, right? And so I think those are two things to really wrap your head around here. So what I want to do here is I did this. I got this graph. You know me, I like my graphs. And so it's a very rough sketch. But what you can see here, I'm going to use a blue. Actually, I want to use a yellow. Let me try to use a like really bright yellow for this. There we go. So as we look at this, so what we can see here is back in the 1980s, in the early 80s, what happened is interest rates went up, and these were like 19%, right? So what happened was, remember, 1979, the federal funds rate was here, and they jacked the federal funds rate, the FFR, federal funds rate. They jacked them up to 19%. And so interest rates, and once again, this is not to scale. This is a situation where, even though it's not to scale, I did this just to teach you a concept, just to like get you to really understand philosophically how this works, to understand why there has been positive arbitrage in non-direct recognition companies, but why that is not going to be the case. And in fact, it could flip against you a little bit, right? And so I'm gonna get into this, and here we go. So what you see here is the white line here I have right here. The white indicates the interest rates, and the green, I should have done this. The green, I didn't do it. The green is dividend rates, okay? So when we look at that, now we say, okay, so the white line was here. You can see it started at 19%. We lived, and I've done a lot of videos on this. We've lived in this decreasing interest rate environment, this declining interest rate environment, all the way to 2008 when we had the crisis. They hit zero, and then for the past decade and change, we've lived in the lowest interest rate environment that we've ever seen. And so now we're seeing interest rates starting to tick up. And therefore, we're going into a different environment when it comes to how assets, especially assets like whole life insurance, will behave, right? Because here's the deal. What happened is there was this crossover point right here, okay? Where the dividend rates before were lower than the interest rates. So there was no positive arbitrage in this spread, right? And then what happened as interest rates jacked up and interest rates kept going down, what happened was eventually there's always a lag, there's a crossover point, and then the dividend rates, because of the way that life insurance companies invest in bonds, and there's like a trail to how this all happens because of how they invest in bonds. Once again, this is not to scale, but then the dividend rates were higher than the interest rates, and they were falling. And as bond rates fell and the fixed market fell, then the dividend rates kept trailing and falling as well. That's why dividend rates have been going down. That's why if you look at the current assumptions in whole life insurance policies, while they've performed okay, the performance has been getting worse and worse and worse over the past 30 years. And that is just reality. It doesn't make it a bad thing. It just means this is what life insurance companies do. They manage your risk, right? They are going to be managing the purchasing power of your money. And as the fixed market goes down, so there too will the dividends. But if you're thinking about this from a long-term perspective and you're thinking about this as a savings alternative, not an investment, those are all totally normal things. You just got to understand what you're actually getting involved with, right? Not only would I say, are they normal? I would still say they're hyper powerful if you understand how to leverage this systematically. And that's the power of infinite banking when you look at it from a pure perspective, right? And so, as dividend rates kept coming down, what's happened is now they kind of leveled out. Interest rates hit low rates, and so now what's happened is now we could do things like utilizing like cash value lines of credit, where we could get a cash value line of credit at like 2% because interest rates were super low, right? And borrowing cost inside of the life insurance companies could be lower because like bond rates, when you look at interest rates, bond rates also hit, that's pretty light or pretty dark. Here, I'll change this. But bond rates here hit, on a 10-year treasury note, hit sub 2% in cases as well. So remember, the performance of the general fund is going to be directly tied to bond rates. And so a lot of these bond rates were, in the 2% range, 3% range. And so life insurance companies then had to reduce the loan rate for internal policy loans to, let's call it 4% in a lot of situations. Well, the dividend rates, because they're looking back and they've got 30 years, they've got stuff from 30 years ago, that are bonds that are still supporting the portfolio today, right? And so these higher rates right here are supporting the general fund, which is supporting the policies today. And the problem is these are all maturing every single year, and that support is going away. That is why they had to create Section 7702 to relieve some stress because of this long-term low interest rate environment on the insurance companies. Now, in a way, the rate environment going back up is going to be a godsend. It's going to really help the environment. But once again, you have to understand how this stuff works, right? And so now when you look at this from an infinite banking perspective, now we see here, we see the interest rates going up. And here's the deal. This is totally speculative. And I need you to know, I'm looking at this from a speculative perspective, but I'm also looking at it through the lens of like, okay, I believe this needs to happen, right? So interest rates need to go up. And if interest rates keep going up to control inflation, which I think they're going to, eventually, kind of like what we saw over here, where we had this crossover point where dividend rates were lower and then they got higher than interest rates, dividend rates we're actually kind of already hitting this crossover point where the cost of borrowing is going to go higher and the dividend rates are going to go up, but they're going to trail and they're going to be underneath the costs. So whereas you had positive arbitrage in this gap right here, right? This gap right here was positive arbitrage that you could earn. This is the thing. This is not something that's fundamentally built into life insurance policies. This is much more circumstantial. It's much more environmental. And it's due to the fact that we had a reducing interest rate environment for such a long period of time. And the problem is we have all these people that have been doing this for a short period of time. And by the way, myself included, I just like to think I'm more of a scholar that likes to dig in and like learn this stuff and really understand the fundamentals, not just the clickbaity titles, right? And please don't take that as like an insult to anybody, because like I have mad respect for everybody who's doing infinite banking. I just really hope everybody understands this. And I think the people that are doing infinite banking from a pure perspective are understanding this, and they're not just selling on arbitrage and the simple things that are really like, listen, I get it. You can market and you could sell that stuff. But here's the deal, no matter what, and I think the good thing that I resonate with for anybody who is doing that is that one way or the other, they're helping people, right? Because I think if you get people into this and they do it the right way, whether they realize it or not, even if they think they're getting positive arbitrage like this and they don't, what I'm going to show you as I keep going on is you're still going to be good. You're still going to be in a better position than you would have been otherwise, right? But once again, I don't want to blow smoke, right? Like I want you to see that, this is what it is. I'm gonna go here and I'm gonna do this, and I want to go, we'll use teal. Okay, so here now we have this crossover point, right? This crossover point that I was talking about right here. And so as we look at this crossover point, what's happening is the the dividend is now going to be lower than the interest rates. So now we have negative arbitrage. And as we have negative arbitrage in this little gap right here, this is the future, okay? This is, and we're already seeing it. We're already seeing it in cash value lines of credit. We're already seeing it in like, I got a notice from a carrier that the loan rates increasing. I'm just going to write an up arrow. So loan rates are going up inside of policies. The cash value lines of credit are already not making any sense. They're up in the 6% range. You can get cheaper policy loans than cash value lines of credit. A year ago, this made all the sense in the world. I could show you, you could get a cash value line of credit. You can go back and you can watch my videos. That was a way to get positive arbitrage, is by utilizing a third-party bank, and you could have done it on virtually a guaranteed basis. But the problem is now the environment has shifted, right? And so as the environment shifts, you no longer have it. You got this gap here where you're going to have negative arbitrage. And that is like, listen, this is an absolute principle when it comes to whole life insurance. You can't fake this. Like, and I'm not saying you can't have positive arbitrage right now. If you're buying this in 2022 right now, that you don't have positive arbitrage if you exist in this window, right? But the fact is, you may not be getting positive arbitrage for much longer. And there may be absolutely nothing you can do about it, and that's okay, all right? So I hope that makes sense there, because this is a really, really key thing, especially for all the agents out there. You need to understand the cycle of this. And by the way, this cycle goes back with the cycles of interest rates. It goes back years and years and years, decades and decades before this, where this cycle that we're looking at right here, where we had negative arbitrage, is exactly what it looked like right here, right? In the 70s and 60s. That's what it was. We were here in the 70s and 60s. And it just reverses. It's a wave. It's just the way it goes, and that's okay, okay? So that is that. So it's not about positive arbitrage. Here's the other thing that I have to say to this. This is where I'm going to go on my little tangent about infinite banking and index universal life. Because of the fact that it's not about positive arbitrage, it especially impacts the fact that if you look at infinite banking and it's not about positive arbitrage, and you look at everybody selling infinite banking that is utilizing index universal life as the core vehicle for infinite banking, they just don't understand the tenets of what infinite banking is all about. They don't understand fundamentally how infinite banking actually works and what the purpose of it is, what the philosophy of it is. They're selling it solely on the positive arbitrage. And the problem with index universal life is the fact that, like, let's face it, index universal life is illustrated with positive arbitrage right now because of regulation AG 49A and other things. It allows it to be run with a positive 50 basis of arbitrage. So when you look at an IUL illustration, when you take policy loans from it, it works and it looks beautiful because it's got 50 basis points of positive arbitrage, and the policy is going to grow by more than the policy loans take. And that's why some of these carriers like MPI allow you to go out and they say, all right, they don't call it infinite banking, but even Curtis Ray, he goes and says for MPI, he says you can actually utilize MPI for infinite banking. It's like infinite banking, but better. It's an enhanced infinite banking is what he call it. Well, nothing could be further from the truth, because go talk to any life insurance carrier that sells IUL and they tell you, if you're utilizing your policy loans to get more insurance, to pay for more insurance, which is what the relock feature is inside of MPI, just to use that as an example, then you are taking more risk. You are drastically increasing the chance of lapsing the policy. Back in the day, they used to call this hyperfunding. And now, they've actually pretty much barred that practice. And the only place I've been able to see that kind of happen is MPI, and I'm not sure how he pulls it off. But the relock feature is simply borrowing against the policy to then purchase more insurance and increase your cash value accumulation. And it all works based on the fact that you're able to illustrate positive arbitrage. But the bottom line is there's more risk and more volatility, because even 1 or 2 years of negative years can absolutely blow a policy up if you're in your 60s and 70s when the cost of insurance are high and you have the loan charges and all this stuff. Because if you have a loan rate of 4% and then you have a negative year, well, now you have all the cost of insurance and that 4%, it can blow the policy up because that's a negative. It's extra cost, which increase the net amount at risk, and all these things can go wrong. It's harder for a whole life policy to have problems because whole life insurance is always going to have growth every single year, no matter what. So it's a bit more predictable. It's a lot more predictable, quite frankly, right? So here's the deal. You can utilize the beautiful thing about a properly designed whole life insurance policy. I don't even want to call it infinite banking, but this to me is what infinite banking is it's a financial system, it's a structure, it's a philosophy that is ultimately a set of rules, and it's a filter that you run all of your financial decisions through, right? And when you look at it like that, now you're saying, okay, if I have this this account that all my money is in, that I'm running my decisions through, well, the amount that I have that account capitalized, right, is going to, as my own bank, right, that is going to dictate how I handle that, right? Like if I have hundreds of thousands of dollars or a couple $1 million in that account, well, then that's obviously more advantageous. I have more flexibility, but and I could do more things with it. But at the end of the day, it's about flexibility and control. So what I want to do is I want to make sure that I'm utilizing this this account for growth, for investments, for cash flow, and not for liabilities, not for lifestyle. Because think about it. Let's go back to this. Let's go back. And this is just fundamental, right? Think about it. This is where it goes wrong, okay? Listen, I'm going to tell you that, and I've done videos on this, if you're going to buy a car and you're going to buy it anyway, there's going to be a cost to that. You always want to look at the cost of money before you make a decision. But a lot of times utilizing your policy will make sense because of the control, because of the benefits that go with it, the flexibility and the control. But the problem is, this is where it gets really, really gnarly and where it gets very misleading in the infinite banking space, is because people say, well, you should finance everything in your life through a banking policy because you have this positive arbitrage, right? You have this positive arbitrage right here. And while that has worked, it doesn't mean it's going to work forever. And if you're getting this policy now, I could pretty much tell you that if you believe, this is why I've been saying to people, you need to make sure your money is in alignment with your values and beliefs. If you believe that the next 30 years is going to look like the last 30 years, well, then that's up to you to take that risk. But I'm just showing you this so you understand how it could look if you believe what I believe, right? And you believe rates are going to go up, and you believe that we have to, otherwise we get a lot more problems, right? So if you believe that, then you realize, like, all right, it could be negative arbitrage over the next. And if that's the case, and if there's negative arbitrage, now all of a sudden flowing all the money for everything we spend in our life through our policy doesn't make any sense, because it's going to have more expenses that go with it. However, check it out. If we look at it through the lens of saying, all right, I know that that's going to be the case. I want to utilize this for investment. I want to utilize it for cash flow investing. I want to utilize it for capital purchases that I'm going to make anyway. Now, there are ways that it can give you more flexibility and control and more efficiency in your life, because let's face it, if you, the one part about this that's awesome right now is, like, there's a company we work with, the loan rate right now is 4.08% annually, right? Okay, 4.08% annually is right now, and it's tied to the Moody's bond index, right? Okay, but the cool part, and not every company is this way. This is why not every life insurance company, or, you know, not every illustration is created equally, right? And this is why the ledger of the illustration doesn't always matter. This is the problem. When you buy off an illustration, you just buy off the numbers. That's not telling the whole story, right? Because you got to look and think about, how are you going to use it? How's it going to perform? And what are the internal costs and fees? And how you behave with the policy is going to potentially impact how the policy performs, right? So when you go to borrow, I could show you the Moody's bond index right now, this 4.08%. They may show a lower cash value, but the bottom line is, even though they're showing a lower cash value, if they have a lower loan rate, and then that can help it be more efficient, that's going to be a good thing. There's another company that has a 5% loan rate, and they're upping theirs to 5.5% right now. It's tied to the Moody's bond index. Now, this company's dividend is higher than this company's, right? However, the bond rate just went up, And going into this, and the guarantees are higher here, right? Higher, lower here for this company, for company A and company B. Company A has higher guarantees, lower dividends, lower loan rates, which is good. It's tied to the Moody's Bond Index, but here's the deal. It can only go up by half a percentage point per month. That's 50 basis points. Should have just wrote 50 basis points. That is, even though it's tied to the Moody's Bond Index, even if the Moody's Bond Index shoots up, the loan rate here, the worst it could get is 4.58, right? That's the worst it could get in the next year, right? It can only go up 50 basis points per year. This company can actually have the loan rate go way higher. And so you have to look at all the different variables. The bottom line is all these companies are managing risk. That's what life insurance companies do. So if you're just looking at the ledger, then you're not understanding. And that's why from an infinite banking perspective, you should never rely on the ledger to be the reason that you buy infinite banking policies. You should understand the philosophy and how you plan on utilizing it. That's why I'm saying for entrepreneurs, for business owners, for real estate investors, for people that maybe are day traders, for people that are doing stuff like that, where you're trying to have control, flexibility, and manage it from that perspective, then it makes sense, you know? And for anybody that needs an emergency fund, I'm a big believer the best place to keep it is inside of, I wouldn't call it an infinite banking policy. So actually, let me talk about that really quickly. And like I said, I'm gonna go all over the map on this based on where, what goes in my mind as I'm talking through this stuff. Cause you know, like I said, I didn't script this out. Like I have a couple bullet points, but it is what it is. So as we talk about infinite banking, there's the whole life policy, and then there's the IBC concept, right? Infinite banking concept, right? So these are two things. These are not the same thing, right? These are different things, okay? They are not the same. And so the infinite banking concept is a philosophy, whereas the whole life policy is a product, okay? Now, the product can be used in many ways. It can be used as a capital reserve account. I'll just put cap res. It could be used as an emergency fund. It can be used as an opportunity fund. It can be used for a lot of different ways in your life. And I would argue that every single person in this world has a way that they should be using it. That's why I believe whole life insurance should be a foundational component in every single person's life, because it is a way to get your dollars to perform more than one function. And so, but make no mistake about it, it is just a product. And I've been explaining kind of how the flows of that product work, right? And so infinite banking is the philosophy behind the product. You're not utilizing this product for banking until you capitalize the product, right? You got to capitalize it. Now, some people are able to do this faster than others. Some people do it really fast, and some people, it takes years to capitalize it properly. Some people don't have a lot of cash flow, and so they need to save $4,000 or $5,000 a year into a policy to save further emergency fund. And they implement the mindset of, I'm going to pay myself first. I'm going to invest in my, save into my emergency fund. I'm going to capitalize my emergency fund. And that once I capitalize my emergency fund, I now, depending on what's going on in my life, also have an opportunity fund. Now I can basically play market cycles. It opens up opportunity, it creates flexibility in my life. And now we get back down into the tenets, excuse me, the tenets that I'm talking about here about flexibility and control. Now you should always use these policy loans for investment in yourself, investment in your business, investment in cash flow assets, investment. The reason is, like, in the past, we've been able to use them for depreciating assets because it just worked, right? Because it's environmentally it worked. But going forward, I don't think that's a circumstantial benefit that we've had. It's not an absolute principle that you can lean on inside of infinite banking. And I need you to really understand the differences between those two things, okay? So that is really key to understand. Now, and I talked about the discipline system. So here's the deal. I want to talk about this for a second, because this is a big deal. A lot of people talk about earning uninterrupted compound interest, right? You never want to interrupt your compounding. Myself, I'm guilty of that as well. So let's talk about policy loans. A lot of people will tell you that policy loans are simple. You pay simple interest while you earn compound interest, right? But here's the deal. Let's just call it even, and let's just say it's a 5%, okay? And let's say I take $100,000 and I borrow against it, and that $100,000 is going to compound. If I'm earning 5% and paying 5%, simple interest, that means I got 5,000 year one, so I got 105,000, right? That's my interest. I earn 5,000, or I pay 5,000. That's I owe 5,000. This one I obviously earned it, right? So it's compounding. Now here's the deal. People talk about simple interest versus compounding, but this is where people also get into a lie. They talk about the positive arbitrage, which I've kind of showed you, especially, and by the way, there's no positive arbitrage in the first couple of years of your policy, no matter what, even as it stands right now, even in the current market that we're in right now. But they talk about the fact that you pay simple, but you earn compounding. But simple interest, if you don't realize it and you don't pay it, because a lot of people say, well, you never have to pay it back because it's positive arbitrage, so you can borrow against it, never have to pay it back. And that is not a banking tenet, right? Like the whole idea that Nelson Nash said is treat your policy like the bank. And if you were to ever borrow against the bank, borrow from the bank, you're going to pay that loan back, and you're going to pay it back with interest. So what's going to happen here is you want to make sure that you understand minimally, by the way, minimally speaking, you want to pay the interest. You want to pay that $5,000 and you want to get back to only owing that. Why is that? Because if you do, the next year you're going to start off with 100,000, and so this is year one. You go through, you pick up a $5,000 expense, right? So that's going to be cash flow. You got to make sure you can handle this interest expense with cash flow, okay? And then as you go down, you pay that cash flow, you get back to 100, and so then year two, you have a 5% interest again, and that's 5,000 bucks. So you're going to have 105,000, and you repeat the process, okay? Now on a compounding basis, this is more clean. You got year one, you got 105,000. Now year two, you got 5% again. I don't know what this is, but it's like 5,000. Let's just call it 250. I think that's it. So now you're at 110,000. 110,250. Okay? So now we're earning compounding on compounding. If you manage that, I picked up a $5,000 expense, but that $5,000 expense, because I managed the interest properly, it allowed me to then start creating opportunity. So here's the deal. This works. This fundamentally, when you take this out and you do that over a 30-year period, this becomes an extremely, extremely, extremely powerful concept, right? It really does. But the problem is this isn't how it's pitched by most people. This isn't how it's taught. And you're not going to be earning uninterrupted compounding because there is an expense. You can't just ignore this expense. And this is why I talk to people is like, yes, fundamentally speaking, if we look at what our options are for a safe, liquid, accessible capital, nothing in the world beats this, right? This is why I love it. I just don't love that it's misrepresented because, yeah, you're earning uninterrupted over here, but you cannot negate the fact that out of cash flow, you got to be able to manage that. And you can't negate the fact that, there's nothing wrong with that. And this is why I think it's important that you have to go buy cash flow assets, CFA. That's why you have to use it for investments and not depreciating assets like cars and stuff of that nature. Because, while it sounds sexy and it's great to be able to sell a lot of policies and get people to like buy into something that they don't fully understand, it's not really how it works. Now, there are certain situations where you could go buy a car. I know I talked to somebody the other day that has a Corvette, and it was like a 2002 super rare limited production Corvette. He bought it with a policy and he ended up doing it. And the Corvette today is worth more than what he paid for it. But once again, he knew what he was doing. He was investing in stuff that he understood. He wasn't just going and buying a car. So it could be collectibles. It could be a lot of different things. but you got to make sure whatever you do, you're investing the money. You're not just, going from there. So when it comes down to it, I just want to kind of like summarize this for 1 second, because at the end of the day, remember, if I didn't do this, right? If I was erasing this down here, and I said, okay, we're gonna look at this, and yes, I have simple interest. And I got the $100,000, and I'm paying simple interest, but I'm earning compounding, right? So that's year one. That's $105,000. It's simple interest, right? But now I have $105,000. If I never paid that loan back the next year, I've got to pay 5% on it, right? So what am I doing? I've got $110,250. So if I don't manage this loan, yes, I have the flexibility and control to be able to manage it. It's not going to hit my credit report. There's a lot of, once again, it's a lot of flexibility, a lot of benefits to it, a lot of control. But if you don't manage it properly, then you're not really ahead. You're not really earning uninterrupted compounding interest. You are, honestly, you're kind of putting yourself in a challenging situation potentially that could blow up on you. And this is one of the reasons that I've started really saying to people is like, you are not where you are in life because of who you are in life. Like, and there's no judgment to that statement, but this is a phenomenal concept, right? Leveraging the policy is a concept. If you manage this and you give yourself the opportunity over 30 years to start earning this, and you pay back the loan, you treat yourself like the bank, and you implement those principles, that is pure infinite banking. And from that perspective, that is what I'm talking about, where this is, it is just a product, and you're utilizing it for an emergency fund, right? You're utilizing it for these things over here. That is what you're doing until you have it fully capitalized. Then you can implement the philosophy when you're ready to manage it. And now you're going to be able to put your life into acceleration, into overdrive, right? And this is why I love doing this, right? Because when you really understand infinite banking at its tenets, and you understand market cycles, and I do this all the time. So if you've watched me, you've seen me do this a bunch of times, right? But this is the reason I say it, is because by utilizing this product to try to capitalize your life, stop investing and taking risk unnecessarily right out of the gate. You save, you utilize. This is your whole life policy. Go slow to go fast. You capitalize your life right here. And when time happens right there, and the market goes down, and you're well capitalized, and now you have invested in you, right? When you've invested in yourself and you've become who you need to be, because make no mistake about it, if you dedicate yourself to getting better and becoming who you need to be in this environment right here, while you're saving and you're capitalizing your life and you're utilizing a whole life policy as a foundation of your life, and you're using that time to invest in yourself and become who you need to be to prepare for this opportunity right here, now it's off to the races, right? That's when you pour gasoline on the fire and you never look back. This is how you take what would normally be a 40-year window, and you're able to get financial success right here. But all the while, most people would look at this first 10-year window and they'd think, man, Chris is so far behind. But the next 10 years, you're gonna blow by them like they were standing still. This is the classic tortoise and the hare story, right? So really important to understand. And I'm trying to think, like, I don't know that I want to get into anything else. This video is getting kind of longer than I thought it would, honestly. But it's really important, So what I would encourage you to do is, if you have any more questions about infinite banking, about anything I've been talking about, any comments, I'm happy to do more videos on this to dive deeper. I'm sure I'm actually kind of contemplating doing a live on this at some point in time. But if you have any specific questions in regards to anything I said, how it pertains to how life insurance works, how whole life insurance works, how index universal life works, how infinite banking kind of policies and philosophy and strategy and design work, reach out, leave a comment in the comment section below. I'll do my best to engage with every single, question and comment, and we will, we'll do our best, and we'll go from there. And hopefully I'll be able to give you peace. What I want to end with is, hopefully you're getting, kind of picking up what I'm putting down here, is this still, everything I've said, all the kind of negatives or the truths that I've kind of put behind it, all that said, I still believe that a properly designed whole life insurance policy should be a foundational cornerstone asset in every single person's life at some point in time. How you leverage it is what turns it into a banking policy with the philosophy, right? Now, you're probably, a lot of people watching this are not there yet. Maybe you are there yet. Maybe you are able to capitalize and you could get going and you could leverage it for investing in assets. And it's just the purpose of this is for you to understand really the internal workings and how it all kind of comes together, kind of some of the misunderstandings that a lot of people have around this stuff. And, you know, that'll make you a more educated consumer. And if you are interested in getting a policy for yourself and to really figure out if it fits in your life, I would encourage you to reach out. I'm going to put a link in the description below. You can talk to somebody on my team that can help you answer all these questions, guide you through it, and kind of go from there. This isn't simple stuff, you know, and once again, I'm doing this video because of the fact that I've done so much content kind of exposing IUL for what it is. And honestly, I've done kind of a crap job talking about the not so pleasant side of infinite banking. Once again, I'm not saying this is not the pleasant side. This is just the real side. And the good part about infinite banking and properly designed whole life insurance policies is that the real side of it is still really, really awesome. The real side of it still should be an asset in your life, right? And that's why I love doing what we do, but you should never put your money into anything you don't understand. And so hopefully now you understand it a little better and it actually excites you because that clarity gets you to realize that it's not all about the arbitrage. And even without the arbitrage, it still makes sense. And that's it. So anyway, until next video, have a blessed, inspirational day. We'll talk soon.